Welcome back. It is Tuesday, and this is Vetted VA Live. We had a few weeks off, so we're back here for another 8-week run every Tuesday, 5 o'clock Pacific, 8 o'clock Eastern, and whatever the in-between times are. We get together here with a couple of the vetted pros from the group and go through exactly what topics are coming up in the group, questions that you guys want and need answered in a better and more in-depth fashion than what we're able to do just in the Facebook group, where someone posts a question and then we have a series of answers and back and forth there. But more importantly, what we love to do here on the show is answer questions live. So if you're in the Facebook group, you're watching this, if you're out on YouTube and you're watching this, and you have a question that's VA related, mortgage, real estate related, just housing in general, we are absolutely here to answer those questions. So you probably heard me there mention the YouTube channel. Most everyone comes to Vetted VA through the Facebook group and are probably watching through the Facebook group. So if you're watching this either live or on replay, go out to the YouTube channel. It's youtube.com/@VettedVA. Check out the channel. There's definitely some additional content there, some nice videos detailing issues that are important to veterans. So with that, let's introduce tonight's esteemed guests, both of them back. I think we had you guys just both a couple months ago, so not too long ago. But we have here on the top row here with me, Brandy Brickler. You are currently in Austin, Texas, but help borrowers both in Texas and Hawaii. How are you doing tonight?
Correct. Yes, I am doing good. Doing good.
Well, I am glad to have you guys here. You both have experience with the one-time close stuff. Josh Baker, also in Texas, Angleton, Texas. Where's Angleton, Josh?
Yeah, I'm about an hour south of Houston, so.
Perfect. So you get all the fun hurricanes and swampy weather.
And that's something we always got to deal with, and so it's season.
Perfect. Well, let's just jump into it. Brandy, why don't you walk us through what is a one-time close construction loan, and then we'll jump in and we'll talk about, in the context of VA underwriting guidelines and doing it with a VA loan, what that looks like for borrowers.
Yeah, so a one-time close construction loan is a loan that is actually for the construction of a primary residence that just in short, we are going to close that loan actually before construction starts, and then construction will move forward and you will move into the house after the construction, as opposed to like a two-time close where you're going to contract on the house, build the house, go through the entire process, and then it will be rolled into a VA loan after the fact. This is going to close with your VA home loan right up front.
And that the benefit there is the certainty in the process. You're not wondering, what does this look like when my home is done? What did I end up financing? And then having to get a new loan after that, right?
Oh yeah, there's a lot of nervous home buyers around this product. So this is definitely something where you're going to learn a lot more about the loan type before, because it's already going to be closed.
Perfect. So Josh, why don't you tell us a little bit about the concept of purchase versus refinance and what that means? When we talk about a refinance in terms of a one-time close, this isn't a rehab loan. It's not, I own my house and I'm going to put an addition on it or renovate it. But walk us through what the difference is when a lender is talking to someone about, is this purchase or refinance in terms of a one-time close?
Right. So mainly, kind of what that means is, is the purchase of the land going to be, kind of all in one, or do you already kind of have the land and we're going to, refinance that land into the whole construction of the process. And so that's the main difference between it. That is doing it that way though. If you have the equity in the land up front, you're able to use that for closing costs or anything like that. And that can, definitely help. So
why don't you talk about that a little bit? So if you already own the land, so there's a couple of different ways of doing it. You can own the land and you can own it free and clear. You can own the land, you can have a loan against it. You can not own the land and be acquiring the land through this process. So what does it look like? And assuming that we're talking about the situation you just went through, someone owns a piece of land, nice lot, it's worth $100,000. How does that help them relative to the veteran coming in and saying, I'm going to go buy that $100,000 lot and build my house on it?
So that does help them. The main thing is coming in with that equity, so they're able to use the value of the land, and that value of the land is going to translate over to the value of their entire property once they add a house to it. Because once you go through the construction process, they're going to appraise the whole property as a whole at the end, and so they're going to take into account that raw land plus the new building that you're putting on top of it. And so that's how you can use the value of that land into that.
Perfect. Brandy, when we're talking to veterans about this, I mean, this is going to be done as a conventional loan as well, but to veterans specifically who can do 100% financing, what does the eligibility for this look like relative to just qualifying for a standard VA loan? Is there any difference? Would anyone not qualify for this that does qualify the other way?
No, there is absolutely no difference in between qualifying for a VA one-time closed construction loan or just a standard purchase. Your entitlement is your entitlement. And because there is no max loan limit on your first time use of entitlement, you can go as high as the lender will go. Now, some lenders will cap at 1.5 million, some will cap at 4 million. As long as you're qualified financially and this is your first time use, then you can move forward with a purchase as high as you'd like. There are some parameters when I say as high as you like. That doesn't mean that you can go out and purchase a $300,000 piece of property. There is also some limitations on how much of this loan can be the property and how much of it can be the house. So some lenders will cap it, say, a purchase price of $150,000 for land. The remaining of what you're qualifying for will be the construction of the home.
Mm-hmm. And can I touch on a little thing on that? So actually, another thing is lenders, a lot of lenders like to cap it at 10 acres is another kind of, thing that we kind of see out there as well. And that's because if your land starts getting above that, then the value of the land, kind of like Brandy was saying, that value of that land gets to be over, over what the value of that house is. And so if you own that land, you may have to, and it's larger than that, you may have to go in and divide it up and parcel it off.
I actually have experience with this, so this is pretty cool because I closed one with a veteran who had 18 acres of land, and just because the appraisers for the VA do a sales comparison approach when doing your appraisal, not a cost approach. And for that reason, they're not valuing the land separately. So you can build on a 20, 30 acre lot. But when you are valuing the property, the lot that the house is going to be on, you don't need to separate it by deed. You can actually just separate it by, this is the 6 acre plot that the house is going to be on. And the appraiser will value it that way. That was definitely an error that I made when doing my first one-time close, is that, we sent the appraisal back to the appraiser and said, no, we want you to value the entire land. And while she went back out, did her job, came back in, nothing really changed as far as the valuation for the land because they don't separate the two out when doing the appraisal for the VA loan.
Well, you guys just kind of touched on two different topics that lead me back to the same thought. We talk a lot here on the show that from lender to lender, some direct lenders versus brokers, and even brokers in the wholesale channel, we have lenders that have overlays. We have lenders that follow the VA guidelines strictly. These loans, is it safe to say or fair to say that almost every lender is going to set up their own guidelines of what they're comfortable within this? So every lender is going to have overlays. Brandy, you had mentioned some lenders aren't going to let you go over 1.5 million. If you need
Correct.
that, then you've got to go find one of these lenders that's going to go 2, 3, 4 million. You may have a lender that says, hey, we don't want the land value over X, whereas another lender is comfortable with that. So it sounds like that's an important issue that if you're talking to someone, not just your loan officer having experience with it, but also possibly having multiple sources.
It definitely is. And this is one of those times where these overlays are going to be different. Now, we talk a lot about the VA loan not having a minimum credit score. Well, for a VA construction loan, that's going to be not the case for almost all lenders. They are going to have a minimum credit score. And generally speaking, it's around 620.
And how does it relate with this? Is this product always going to be a manual underwrite, or is this something where you can get an automated approval with it?
That is a really, really good question. I don't recall ever, like, I ran, so the client is being automatically approved or doing automated underwriting when you're
Right.
pre-qualifying them. So it is going in, I think a manual underwrite would be a little bit more complicated for whatever reason. If it's a manual underwrite, I don't know if it's like exceeding debt to income ratio or if it is a credit score thing. I think you're less likely to move forward with a manual underwrite on a VA construction loan than any other type of VA loan.
I was just wondering if the VA engine is just equipped to even underwrite these, because we have, it's just a little bit of a different process. You're arriving at your loan amount with the land value or the land acquisition cost plus your construction costs. So the land piece of it is pretty easy, right? The appraiser is going to tell us what the land you own is worth. Your acquisition cost, if you're buying it, you're gonna have a contract price, and the appraiser is going to weigh in on that, and then your total build cost. But Josh, why don't you walk us through maybe the construction side of it? How do we arrive at a number that we know is legitimately going to build the house you want and allow you enough funds to get that done?
Yeah, so there's quite a few things that go into a construction loan that don't go into a regular loan. So the biggest thing on that is your fees, upfront fees are going to be a lot more because you're going to have a lot more doc prep fees. You're going to have more inspections. You're going to have what else? You're going to have modification fees. You're going to have different fees on depending on what certifications you need. So there's a lot of things, and depending on what builder you go with, you're going to have plans. You're going to have plans made and drawn up. That's another fee there. There's there's a lot of different fees that just come into it, and it's you also have contingencies outside of that, and so it's one of those things that it's definitely on a situation by situation basis. What comes up, but there's definitely quite a bit more that goes into it, and so it can whenever you go through the go and close on it, your closing costs are going to be a lot more.
So we've got some additional closing costs as part of the process, as you mentioned. We'll go through it in a little bit later, but Brandy, when you're meeting with a client who's looking at saying, hey, I want to build a house, what can I qualify for? Or do I qualify for the scope of what I'm thinking? How are you working your way into the numbers in terms of land, construction, closing costs, total loan that borrower is qualified for, and ensuring that you are going to have an approvable loan on the way in?
Yeah, so I guess I think as a loan officer, I think we probably have the discussion about VA one-time close construction loans probably 90% more than we actually have someone going forward with them, because it is a lot to deal with. And I'm always talking to anyone who's never purchased a home before. This probably isn't the best way to go for your first home. Like, you should own a home before you move forward with this very, very big process. And and that's not to say that I'm not going to move forward on a pre-approval for them, but you really should have the experience of owning a home before you move into this process. Now, pre-qualifying a person for a loan is just the same as pre-qualifying for any other type loan. But like Josh said, there is a lot more closing costs that are going to go into this. And for me personally, I do like to see that a client has significant funds set aside for all of the things that they're going to need outside of the process, which you're going to have to go have building plans drawn up before we ever get into the registering your builder or moving forward with the loan. So there's a lot of upfront costs. I generally say, like, we'd like to see you, somewhere in the $20,000, $30,000 range, so you can manage the beginning of the build price and all of, like, the inspections on the land anything that you need for upfront building blueprints, plans, anything like that. And then on the back end, should there be anything wrong with the appraisal and it come in under value, then you might have to come up with a shortage. So when I'm pre-qualifying people, I want to see that you have funds set aside and that you clearly understand how long the process is going to be, what the fees are, and that you're prepared to move forward financially.
It's a really important topic because all of us, no matter where we are in the country, we've all had a supply issue. So people are having a hard time going out and finding a home they like, getting it under contract, winning a bidding war, all that fun stuff. So many people, first-time buyers included, say, hey, this is for the birds. I'm going to go and just buy a piece of land and I'm going to build it. But what you said is really important, especially in the context of a VA loan. Lots of our veterans come in zero down. They have $5,000, $7,000, $10,000, $15,000 for their closing costs, or they're getting a gift at closing. You're talking about a much more significant sum there. So it is important to know that it's not anyone can successfully do this. It's just, I agree wholeheartedly that it's not necessarily for someone who hasn't owned a home before. Just like when you're a renter, you look at a home a little bit differently than when you own it. You haven't had a system go wrong that you had to repair, whether it's a roof, plumbing, any of that stuff. So then the thought of building it from scratch, I just think you're better equipped when you found a home, unless you're someone who's come up in a building family or a construction industry background, that type of stuff. So it's not to say that you can't do it successfully, but there's definitely some moving parts there.
That kind of makes me think of something that it is the entry level way to sort of get into a one-time close construction, because a manufactured home, a mobile home on a lot, is also a one-time close construction, where that would be constructed and put on a foundation on a lot that you'd be buying at the same time. So that is also considered and is an entryway into this. And maybe you don't need as much reserves, in those types of situations. But, if you're going to build this custom home, that's probably what I'm speaking to and saying that you really need to be financially prepared and should have owned a home before.
We actually got a couple questions here related to one-time close. So let's jump in. One sort of a comment and a question. This may actually be one of our other vetted pros here, but AFR, it's a lender that also does these. AFR's max is $150,000 that they will finance on the max amount for the land. Any amount above that comes out of pocket for the buyer. So if you find a $250,000 parcel and you're getting your loan from them, you're going to come up with that $100,000, despite the fact that VA doesn't have it. It's one of those overlays that we were talking about. So the actual question here is, does UWM or anyone else that does these loans have a higher land cost amount? Do either of you know the answer to that question? It's not something that I have off the top of my head.
Not right offhand. You know what I mean? It's something that I can research and sort of get back to, like while we're on the podcast. Because there's so many different lenders that are now offering it. Like when I first came, joined the broker side of lending, because my retail organization did not do any type of construction loans and had some lenders that were available to do this. AFR was the only person that was offering this loan product. Now we have several other lenders that are offering these products, and we have a looser interpretation of what the VA accepts as a stick-built structure. So a lot of things have changed just in the last year.
And I actually have the guidelines up here for UWM, and at least in terms of quickly scrolling through it, I didn't see that in the guidelines earlier today, but it's a fairly long page. So it's there, but it may take a few minutes to find it. So next question we had is also a good one. Can I still use an agent if I build? Either of you guys have any thoughts on using an agent if you're going to build your own home?
Yeah,
absolutely. And you definitely should.
An agent's always there for your protection whenever you're going through a real estate transaction. I mean that's what they're there for, and they know contracts. So
to me, the first thing that jumps out is if you're buying the land as part of that process, then we have an obvious role there for the realtor. If the homeowner was building on land that they already own, is there any role for the realtor in that transaction, or is it really just you and the builder and the land?
Well, I can say that there's definitely some realtors out there who specialize in finding the land itself, right? So they can help you get the land. But if you already own the land, you could hire them in a different capacity than, you would to have someone, find a home for you. So maybe, you could negotiate commission or, maybe, but really what they're doing is helping you guide through the build process and making sure that you're going through the steps. So there's like a disinterested third party. It's not just between you and the builder. There's someone there to make sure that you're being protected, looking for things that aren't right. Realtors are very familiar with looking through homes that are being built and identifying possible issues. So for that reason, whether, whatever capacity, there's still a place for a realtor.
Perfect. We got another good one that just rolled in here. Is it still considered a construction loan if the construction company says they will build your home and just sell it to you once completed? And this was the easy answer. No, because what we're talking about today, you are actually paying the contractor to build it. You're buying the materials, you're reimbursing them for the labor, all that stuff. When you go to attractive homes that's being built by a builder, or even a spec home, they build one off there, they're incurring all that cost. They're getting financing from their bank, their lender, and they are building that and they're selling the completed product to you at a profit. But the next question here is going to kind of lead us back to what you guys were talking about before. I hear the closing costs are higher, something about a builder fee. Brandy, you want to kind of walk us through a few of the additional costs and where those would come from? And I think this is probably one of the big questions that anyone considering this is going to have and should be made aware of. And we're going to have all of our normal costs, right? There's an appraiser involved. You're going to have title insurance. You need a credit report. All of the things that a lender are going to charge, your recording fees, all that stuff is going to go in there. What are kind of the big line items that you're going to have added to your transaction in a one-time close?
So one of the biggest items that's kind of a surprise to people is there's a lender fee, and the other one is a builder fee, and then there's also a contingency reserves. And in encompassing, some of the lender fees is that, you're not going to be making a payment on this construction loan. Remember, it's going to close before construction starts. And then you're going to make your first payment after the construction is completed. So you got to think the lender is on the hook for, let's just say estimated construction is around 12 months. So 12 months of principal and interest that you're not paying. And that is rolled into one big ball and considered a fee, right? So you're not going to be making payments at all. And for that, this is a pretty extensive fee, especially if you're purchasing a home that is, $500,000. If you think of principal and interest payment over 12 months, what that looks like, it's a big number. And then you're obviously going to have builder fees and contingency reserves. So the lender is going to take, just in case, like let's say you contract to put marble in your or granite in your kitchen or in your countertops, and you decide to go ahead and do marble because this granite wasn't available. Well, there's been a little bit of builder contingency reserves that's held in there for like any kind of transition to materials that needs to be made during the process. So they're building in these fees, and what happens to any fees that are left over. So let's just say we didn't use that 5% builder contingency reserves. Now you were charged for it. It was put in the loan type, but what's going to happen at the end of the process, whatever's left over, it's all been receipted, it's all been taken care of. And then they're going to apply anything that's left as a principal reduction to your loan and change what your monthly payment will be based on the reduction of that, whatever's left over.
And there's also one other fee on there. There's also a construction loan admin fee, and that's a percentage of the loan amount, and that the minimum on that is $2,300, but I think it's right at 0.8% on like government. So that's going to be, and that's an additional admin fee just on top of the. So.
And I don't know how this works in different parts of the country, but how is your title insurance going to be more expensive? The title insurance company has a little bit more risk there in terms of mechanics liens, other things that can come up through that build process. So not going to be tremendously higher, but you're probably paying a little premium on your title insurance as well.
Title insurance, and then also some additional construction insurance, during the process.
So let's talk about, well, actually, I want to go through this. There are some limitations. What are the biggest things that you cannot do, either types of properties? And let's just start with this one, because this is the one we get all the time. Cool. I'm a framer, and I've got all my buddies that are contractors. We're all going to chip in, and we're going to build this thing like 30% less than it would cost. Can you do that?
No.
No. So yeah, no self-help and no sweat equity allowed.
And they really mean no. Like, you could be the greatest contractor on the planet, have built 20,000 homes, and you are not going to build your own home. I mean, you probably have a buddy who can be the contractor, but there is going to be a real licensed contractor vetted and approved for that project, right?
Yeah, you got to think about the risk to the lender if they're letting you build the home that they're loaning you the money for. So that doesn't really create an arm's length transaction, So there's a reason why, because the liability falls on the contractor. There is someone to be held responsible. It can't be the buyer and the builder at the same time. So it's really important that is a big question that we get a lot, but self-help is just not allowed.
So another one here, and this could be a UWM overlay. I pulled this from their guidelines, but it says borrowers cannot combine VA entitlement. So this can get a little in the weeds, but two veterans, non-married, can borrow together and combine their entitlement to buy. At least with UWM, that can't be done. That's something that goes to VA for prior approval, and I'm assuming that's probably why no one is allowing combined entitlement. Would you guys think that's probably consistent from lender to lender?
Yeah, I would think most of the guidelines are pretty similar between the lenders.
We talked earlier, you can't do a rehab construction. You can't buy a house. You can't buy a house or a nice piece of land with a little 1-bedroom shack on it and then blow that into a beautiful house. It literally has to be raw land that you're building a new home on. What about weird homes? We see fun stuff being built out there, the shipping container homes, a barn dominium. Can I build any of that cool stuff?
No. So the biggest thing is, you do have to have comps. And that's the biggest thing that a lender is going to look for. Now, whenever it comes to weird homes, you're not going to be allowed domes or weird things like that. The shipping container.
Maybe you can.
I was going to say, I know barn domes. Is that recently changed with the domes as well?
Yeah, so we were just at the VA lender conference,
Okay.
like that happened in Missouri, and we had a big discussion with the VA panel, the people who are making the decisions, and he's like, it is a home. It is a home, like whether it be a dome home, a container home, a tiny home. A tiny home is just a small home, but it's still a home, right? It has to meet the VA's minimum property guidelines, which I think like square footage wise, it has to be like 700 square feet.
I think 600.
600. I could be wrong. I could be off on the numbers, but I mean, it's a home. So really what we have to do is the biggest pieces, like Josh said, the comps in the area. So barn dominiums, like we are definitely pushing really hard on lenders to accept these properties because they are homes. They're not pole barns. They are actually stick-built homes or steel-framed homes rather. And so there is no difference in that it meets the guidelines as a home for a veteran. So it's really our job as loan officers to be pushing on these lenders and just letting them know what the VA stance is. The VA stance is that it could be a dome home. As long as there are other dome homes to value it against, then the VA does not have a problem with that.
This is my personal non-professional advice. Do not build a dome home. You can build a barn dome.
Probably.
Do not build a dome home. I've never, they come on the market here in California. All the hippies built them in the 70s.
Oh.
You get them occasionally and you just look like, who would buy it? They're just the craziest things ever. I actually bought a dog when I was like 18. I bought a dog from someone and I pull up their house, which is out in the sticks, and it was a dome home. And it was exactly what you would think. Wood paneling, crazy shag carpet, 9,000 dogs everywhere. So don't build.
We have had someone asking, I don't think it was called a dome home. There was a different name for it, but we have had someone ask about that specifically in vetted VA, which I think is really funny because we were all sort of researching, what is the name of this property? Like I've never heard of that or seen it before, but it's a thing. And, as far as the VA is concerned, it's a home,
That's good to know. So let's talk a little bit. Someone's come to one of you guys and you've got them approved for their financing, and let's go construction from beginning to end. So you talked about they have to get plans. They need to get with the contractor. How does that bid process look like? And then how does that come back into you as a lender and putting that loan package together? I mean, we don't need to go into the weeds of what you guys are doing, but what does a buyer, a builder owner need to know of what that process looks like?
Josh, you want to go?
Yeah. So, I mean, the process is, it's a lot, as far as, you have to get your bids in. So you're gonna get everything kind of together as once, and it all has to be planned out. So that's the biggest thing on this, is you have to plan and plan and plan. And so you're gonna have, there's a lot more that just kind of comes into that as far as what you have to plan for.
I think I can jump in and help on that, because like the beginning of the process, I find, is probably the most difficult part of the process. And I can tell you that I've had people who came very squared away. Like they knew, hey, I've been researching for a while and I found a builder and I like this builder. And I have even checked, have they done loans for veterans, right? Because the builder has to be VA approved. And is that a big process? It really isn't. It's honestly 3 pieces of paper. We need the builder to fill out 3 pieces of paper to say that they, it has something to do with their employees. So we have them filled out the pieces of paper. We hand it over to the VA. The VA assigns this VA ID number for that builder, right? So that's an easy process. And finding, a construction person or company that will build the house, easy. Here's where the hard part gets. The builders have to be registered with the lenders. And there's generally a builder packet that we download from each of the builders. We want to get as many builders as we can registered in with these lenders. And we want to get the builders to fill out these pieces of paper. Some of the lenders have a pretty extensive builders packet. And for me, I would say like one of my biggest mistakes is that I'm not a babysitter. I hand over the builder packet to the builder and I say, here, this is what you need to complete. I'm assuming you have seen something like this before. They have to fill out that not piece of paper. It's probably like 20 pieces of paper. And builders are really good at building. They're really terrible at paperwork. And so the longest part of like my process was waiting for the builder to complete the paperwork. And that's sort of deciding on all kinds of things, because in the questionnaire, they're even talking about like materials and costs for each of these things. Like, how did they come by the price of the home that they quoted you, that they gave you plans for? So the lender wants to know all of that information. And I didn't babysit my construction manager or the builder. And so it took 3 months to get that paperwork back from the builder. I kind of left that on the clients to say, hey, you contracted with him, here's the paperwork. I kind of tap them every once in a while, but they also don't check email very well. So the perception of the client was, hey, why is the VA taking so long? Well, the VA isn't actually taking so long. We haven't even gotten anywhere near the loan process or the VA at all. We're waiting on your builder to complete this packet. So that's the biggest piece, right? And then after that, everything goes pretty quickly. It's like a normal loan process. We're going to start the process. You're going to get your loan disclosures. We're going to show you the fees, calculate things. We might talk about locking in your interest rate. And then 30 to 45 days later, you should be closed. The loan should be closed. And then you can begin construction.
By that time, you're going to have all of your estimates in, kind of everything. And so, within that time, you've kind of put together what faucets and, how much your faucets are going to be. You have to think about like all these things, and mirrors, how much are mirrors, and how many mirrors are you going to have? Things like that you have to, think about in the process.
But you never counted mirrors in your house before.
Not only that, I don't think people take into account, and it kind of goes back to saying a first-time buyer who doesn't have experience with owning a home, looking at a home, repairing homes as things go wrong. Even if you've bought new construction, where we answered the question earlier where someone said, someone built this home. Well, the builder says, okay, here's the house and it's 98% decided. Here's the 2% of things that you can pick. Well, when
That's
you're
even hard.
building it, that's even hard. I was going to say I flipped a ton of homes back between 2008 2012, and just the spreadsheet that we would go to Lowe's or Home Depot and have them bid out everything was like 2 pages long of just materials to renovate a home, not to build it from the ground up. That's just to renovate it. And that's with the contractor handling all of your rough plumbing, rough electrical, roofing, that type of stuff. Most people don't understand that a 1,500 square foot house, it could have $7,500 window package. It could have a $75,000 window package. That's
Right?
the type
It's
of
like where
decisions that we're
do the
talking about.
plugs go? Like what corner of the room do you want them to be in? Where do you want your television to go? Like we need to put in electrical there. Like, do you want pendant lights? Do you want, there's so many, there is a lot of questions that have to be answered. And, builders may be familiar with some of these things, but like actually getting them to write it out line by line that we are allocating $10,000 to countertops. We're allocating $25,000 to cabinets in every room. We're, the things that you're adding in, getting them to do that is probably the hardest part of the process.
I was going to say, Josh,
sorry.
No, hold that thought. Is it safe to assume, both you guys, that builders love doing things like granite countertops? Well, again, granite countertops, there's entry level, the ugly granite that you've seen that's pink and black that everyone used in the 80s. And then there's really high end granite that comes in one quarry out of Brazil and is $20,000 a slab. So builders love to just put granite countertops. And you're talking about that packet. You and the builder have to go through and let the lender know we've narrowed it down. It's grade level X or whatever it may be of granite, and it's this much per foot allowance, and they have to be able to look at it and say all of these things line up. And it's everything we're talking about: countertops, windows, doors, moldings, carpet, flooring, vinyl flooring, fixtures. Josh had mentioned, faucets. No one thinks about those. Toilets. A toilet can be $100. A toilet can be $1,000. So
and we also have to talk about builder profit, right? So there has to be a profit margin built in for the builder themselves. And when they're line iteming these things, it might be difficult for them to sort of like, oh, here's what my expected profit is, like it's hard to, put that number. And it's something that is passing through the client, right? They want to know, if this is the house, how did you get to the number? If you're going to say this house is 250,000, how did we get there? Because that's what the lender wants to know.
Josh, what question I wanted to ask you, because we talked about this before, that thought of contingencies and overages and your advice, like this is where it goes.
That's the
because
no
one plans. No one plans enough.
And especially with the OT or one-time close construction loan, once you close, you're not going to go back and add some more on and add some more on and add some more on. So that's the biggest thing to remember is, there's a 5% in there, but it's like 5%, personally speaking, it isn't enough.
That probably brings up a really good question about like what happens if you change something after the fact. Like, let's just say you did say that you wanted granite, but they couldn't get it, and there was something a little bit more expensive, and that was a little bit more. That's where we want to see people have additional funds outside of closing, because your loan is already closed. It's already been funded by the time this construction is happening. So that's where, I have clients right now who's, ordered a stove for their construction. Their construction should have ended in January. It's been back ordered forever. They were kind of forced into getting a different stove at a different price. Well, guess what? They had to come out of pocket for those things. So that's where you're definitely going to come out of pocket a little bit more than you expected. I think you could probably speak to that, right?
Oh yeah, definitely. And it definitely, it's going to happen. Once you start adding things and you're looking at different things, it's bound to happen.
I would say if you're watching this now or in the future and you're seriously thinking about this, go to build.com or Home Depot. Build.com kind of has everything there, and just start looking and say, okay, I need faucets, kitchen faucet, and look at the range of that. Now look at the different lights. hall lights, pendant lights, whatever lights you need in there, and realize the massive range. You can get nice stuff reasonably priced, but if you have that one perfect light that you want for your bathroom, the price can get out of hand real quickly. And even if you have a certain design style, most toilets look all the same, but if there's a perfect toilet that looks great in your modern bathroom, you might have $1,000 toilet. So check it out and do a little homework on that end. So we've got about 20 minutes left to go, and we got a lot of ground still to cover. So let's say you have your bid, your contractors put everything in writing, your lender is happy with it. We start the project. Walk us through, Josh, what happens? Your contractor doesn't say, hey, let me go do $20,000 of work and then I'll get some money. They want some money. How does the draw process start from day one when we're ready to start the project?
Yeah, so they definitely, whenever they get that loan closed, they're ready to start. And so there is that initial soft cost, what they call is they want to, some costs up front. And so, typically they want like a 10%, on their first kind of draw right away is what most builders, want. And so depending on the lender on how they do their draws and how, each lender is different on how they do their draws. That's the biggest thing to remember as well. Some of them will allow 5 draws, and that's throughout the construction process. Some will allow a lot more. And then some will, they bid in the amount of draws into it. And so because at each draw, there's going to be an inspection, and they're going to come out and say, hey, this has been done, and they're going to sign off on it. And then that way that the lender knows, hey, this work has been done. And I have somebody saying that it's been done. And so they know that it's being completed. So, yeah.
Because most homeowners, they don't know. A contractor could say, yeah, we're 20% done. We need a 20% draw. You're like, I don't know. That could be 2%. That could be 32%. So why don't you talk to us just a little bit about what that inspection looks like? Who is the inspector? Who hires them? And what is their background and their role in confirming that what the contractor is saying is truly what is ready to be reimbursed, to keep from getting too far ahead of it and getting them too much money to burn through, and making sure acceptable progress is being made towards completion?
Right. So yeah. So the inspectors that's hired, by the lender, and they're gonna, make sure that they're getting basically that, kind of what they're doing, seeing on the boots on ground is kind of what's being relayed to the lender. And so that's a little bit different than city or county inspections or anything like this. This is this inspector is looking out for you throughout the build process. And that's the biggest thing to remember is, some people can get, upset, but you have to remember that that's there for your protection. There's so many things that happen beyond those walls that you don't think about, that they're looking at every single thing throughout that process.
And if that inspector saw something that was horrifically not to code, they're going to say something. But primarily, they're there to check progress, to make sure we're using the materials that we said we were going to use, that are correct. So it's protecting the lender, it's protecting you. But you made an important distinction there. Your city or county inspector is the one that's coming out and going, yeah, this is exactly according to our plans and what we approved, and it meets all of our local city guidelines or county guidelines and ordinances. Randy, why don't you talk about the draw process? Like, in a perfect world, it would be cool to say, well, okay, it's a $300,000 house. Let's do 3 draws. So we only have to have 3 inspections and 3 inspection fees, and we'll do $100,000 at a time. So that would be simplicity. The contractor would probably like $10,000 every Friday, which would require an inspection. So what's the balance? What does a lender want to see in that process?
So generally, most lenders are going to have a 5 draw process. And so some of that is going to be, obviously, some of the bigger upfront costs are going to be just pouring the foundation. So they may not break that 5 draw process into equal draws. Like the builder is going to have to figure out like how they want to divide the draws and what stages and processes they want to have those inspections take place. So they're not having to have multiple inspections because, they needed someone to look at electrical and framing, at the same visit rather than, splitting that up into 2 visits.
So let's assume we've made it through that process. Actually, there was one piece that I was talking about. UWM will let you go to $4 million. If someone's doing a $4 million loan, that's not going to be a 5-draw process. I mean, the higher you go in purchase price,
Right.
probably the more frequent, and you could have 15, 20 draws if you're building a $2 or $3 million house. Is that pretty safe to say?
Yeah, absolutely. Well, I mean, what's going to happen is that as the builder is contracted and we're in the loan process, the builder is also going to have like an orientation process with the lender where expectations of what the builder is what the lender is expecting, how draws will work, how they request them, what to do. So all that's going to be an orientation process between the builder and the lender. So there's clear expectations set.
From my perspective here, I'm hearing that there's a good chunk of additional work for the builder. In you guys' experience, do you have builders just say, no, we will work on jobs that are financed by the local bank or whoever they're comfortable with and have that process dialed in with and just say, I don't want to go through the extra work to do this?
Yeah, it definitely happens. And, I'm one of my first ones, the builder is like, I've always just dealt with, kind of people dealing with cash. And so it can kind of be overwhelming to them that well, it was a Barno builder. And so, it was, it's one of those things that you have to, really think about. And so, yeah.
What's something that's really cool about that is that I do let builders know whenever I'm talking to them because, sometimes I'll go out and just introduce myself to builders, say, are you registered with this lender? If not, like it takes nothing for me to go ahead and get that process started with some paperwork. So if we can register as many builders as possible, it's a lot smoother. If we're starting from zero and they've never been registered with this lender, it's a little bit more cumbersome. And so if we can get at least a portion of that process done up front, or sometimes I do recommend that I search the builders registered, the lenders registered builders, and then say, hey, here are some builders to start with when you're doing your process. You can check with these people first. But, as someone, the construction loan process is very long for a lender. For your loan officer, like we're taking care of a lot more processes than we normally would. I would love for a builder to just self-finance and sell it to someone, but it just doesn't always work that way. This is a good option for veterans to use this product.
So let's say we're getting to the end of the process. Final draw is coming up. The house is just about ready for move-in. What does that start looking like from the loan side of it? What happens there at the end? We have these contingency reserves. Something has to happen with that. There's a number of steps that can happen there. You guys want to walk us through that?
Yeah. So the biggest thing is any kind of leftover funds at the end. That's going to go towards principal reduction. And so that'll reduce, the overall principal of that loan. The other thing is on that final phase of construction, they're going to come in and make sure that property meets the minimum property requirements for, as per the VA guidelines. That's something that, they're definitely going to, check for. And, sometimes, you're going to have changes on, the biggest thing on there is, you could have, shortages on, escrows or anything like that is another thing to kind of, that could kind of come up at the end is, as far as all that goes.
So we have sort of a final accounting, make sure everyone got paid.
Yes.
Final inspection, make sure it got completed, and we have your certificate of occupancy, everything dialed in. We may have a principal reduction. And Josh, you talked about earlier on, there's a modification fee. So at the end, right, this loan, it's the same loan, but it does kind of get modified there at the end. What does that look like, Brandy?
Oh, I think Josh would be more apt to explain that, the modification fee.
So as a modification, whenever you're basically modifying from a construction loan to a permanent loan, and so at that point there is going to be that there's a final kind of you're going to have a couple of admin fees, a title search. they're just going to make sure that everything's, good to go into that permanent VA loan.
And so is that in a one-time or a two-time close?
Uh,
One-time close?
Yes, that's on a two-time close.
Okay, because I was like, wait, I closed the loan already. Like, I don't know about any modification fee, but I do know that there are some lenders who might float down. So if interest rates have gone down a little bit, that at the end process, like whenever the last thing that they want to do is go through this entire construction process and then lose you because you want to refinance somewhere into a lower rate. They have a lot invested in this process. So there are times, and that doesn't mean that you can strong arm your lender to like make them float down, because every lender doesn't do this. But some lenders, UWM specifically, does have a float down policy. So if rates got significantly better, and there are some guidelines to that, then they'll reduce the interest rate that you locked in at and close the loan with, a year ago when you actually closed.
And like you said, that's not strictly out of the kindness of their heart. It's a business decision. It's smart for
is.
them. They don't want to do all the administrative part of this long process, the risky part where the project can be abandoned, the project can run out of money, any number of bad things can happen. They don't want to be on the hook for that and then not be able to receive some interest and have a loan on the books for a few years. So most likely you'll get someone to cooperate with you. So I think we did a pretty good job of kind of covering the process A to Z, but anything we left out, anything that either of you would like to go through, tips, tricks, advice for this process, things that you wish someone considering a one-time closed loan would actually know upfront, or things that they don't know but should know?
Yeah, I guess, for me, the biggest thing is just to, is think about your budget. It's, that prior planning up front and thinking about the long run.
What is that? Proper planning prevents piss poor performance.
Right. The 7 Ps from the Marine Corps.
Right.
And so that definitely holds true here. And because if you don't, it's going to get you. And that, because there's so many things that come up, whether it's, septic, wells, anything like that. It can, drastically kind of change the value, or sorry, the cost of everything. And so that's one thing that, definitely think about. The other thing is, just, one of the things that I wish I did, is, leave a lot more mementos, as I was going through the construction process, And so that's one of the things that I really like to lead people with, is like, hey, make sure you're leaving mementos, whether it's writing, taking a Sharpie and writing on the studs, doing something like that, I think is, definitely really cool, and adds, that own little special touch to, whether it be your forever home or, just something that, you're putting together. So.
Yeah. I can definitely, just for me to add in, I like to say that I have watched, so I started process with my clients, and, the actual getting through the loan process, getting the builder to do their stuff, and, getting through the loan process, getting through underwriting, closing the loan, then 12 months plus of construction, because, there was a builder who didn't quite finish in time. So, he was like 4 months past. So just watching, the relationship of the clients through Facebook, which I love, because I've been able to keep up with them throughout the entire process of how they're doing this. It takes a lot. You have to, they were living in an RV on the property, using a porta potty for a year, just living in meek conditions for a very long time. And it takes a lot out of two people who are, building this forever home. So it takes really strong, resilient people. And it does take a lot of trust between the client and myself, because I promise you, the first time that you see a loan estimate and all the fees that go into it, and your $250,000 house just ballooned into something that you never thought you could afford in the first place, it takes a lot of trust for you to say, hey, listen, this will all come down. We're all going to settle this in. No one's trying to take advantage of you. Everything is being built in here to protect you and make sure that we've allotted enough So it requires trust and resiliency 100%.
Yeah. And the piece that I would add into it is you need to be detailed. If you're not detailed, it becomes even more important that you work with a contractor that does this a lot and can kind of walk you through that process. All those finishes, materials, choices that we talked about. If you're not dealing with a builder that says, hey, here's this window package, this window package, this window package. We're just kind of used to going into the car dealership and, okay, here's the 8 decisions we have to make and then walking out. This process is not going to be like that. And the more decision fatigue you have, decision delay you have, the more likely you are to have cost overruns, time overruns, which also increase costs. So it's incredibly important that if you think you want to do this, just walk around your house, walk around your apartment and look, what are all of the things that go into building this and what do I want in my house? And know that you need to make those decisions. You need to know what those costs are. You need to make them early upfront in the process. And again, the less capable you are of that, the more important it is to work with sort of a hands-on builder that is very good at walking you through that versus the guy who may make the awesome custom home, but needs you to come to him and say, I want this, this, and this in terms of finishes wise. So
I can tell you 100%, I'm not built for that.
It was, we went through the process and we'll probably never go through it again.
It's a once in a lifetime, right? You think you want to do it and then you do it and you're like, I don't want to do that again.
No.
So we do have a really good question here on the way out.
Perfect.
Kathy got here late. She wanted to know if we're going to send a recorded copy of this. So the recording is in the videos section of the Facebook group. I'll use this as another opportunity to plug the YouTube channel, youtube.com/@vettedva. Go out there, like, subscribe. You'll get notified when we go live every week. Lots of other content out there to keep you up to date on the market, up to date on VA guidelines, everything that you would want to know, completely video-centric. Obviously, there's no written text or anything out there like we have in the Facebook group, but a lot of video content that you consume that you can listen to when you're in the car, depending on what type of YouTube subscription you do or don't have. But all right, anything else you guys have before we let him go tonight?
No, just reach out on Vetted VA if you have more questions. We got lots of videos on the one-time close in there, or professionals who can answer the questions.
Absolutely. That is the best advice. So any questions, one-time close related, mortgage, real estate, VA, non-VA, go out to the group. We have a wealth of knowledge. It just amazes me the breadth of questions that can get asked there. And then that someone in the vetted group knows how to answer any question that pops up there.
I learn stuff every day.
Every day. All right, guys, it was a pleasure. Thanks for being here. And for those of you watching at home, we'll be back next Tuesday with some more pros and another topic. All right. Have a great week, everybody.
Bye-bye.
Bye.